Hello, traders. James Stanley with StoneX and Forex.com. In last week's educational video, we looked at trends as a part of technical analysis. That's a big part of technical analysis because it allows us to glean the current bias, and we could then institute an if-then statement. If this bias continues, then I can put myself in a pretty good spot of managing a winning trade. But that's just a part of technical analysis. While we would always like to guess the direction correctly, fact of the matter is the past doesn't always predict the future. As a matter of fact, uh, history as a guide is something that we should be suspect of. And that's where support and resistance comes into play. Now, there is somewhat of a conundrum. By nature of using technical analysis to try to get trade ideas, it's an effort of trying to be correct. But the reality is support and resistance are important because we're not always going to be correct, because there is always the risk of failure or the risk of loss. And support and resistance is what allows us to look for ways to risk a dollar to try to make two. It's a way for us to seek out asymmetry in markets. And if that uptrend does continue, then great. My 1 unit of risk can allow for 3 or 4 or maybe 5 units of upside. But it's support and resistance where this all comes to life. It's support and resistance that allows us to take a certain approach into an otherwise uncertain world. And that's what we're going to start to discuss in this video, in the next few videos. In this video, I want to cover one of the simpler and I think more innate concepts of support and resistance with psychological levels, also known as round numbers. And this is something that's prevalent in human behavior outside and away from markets. It's something that you've seen in practically every retailer on planet Earth. If you go into a store, prices often end in increments of 99 cents. The reason makes the product seem cheaper, thereby increasing the probability that you'll buy it or that you'll react because it seems cheaper. $10 seems a lot more than just 1% of over $9.99. Thereby, consumers are induced to buy. They're encouraged to show demand to that lower price point. And this is something that has a tendency to play out in markets as well. So we're going to look at this from a few different perspectives. I want to hit on one important point before we go any further, and that is what separates actual support and resistance from just a theoretical level is markets responding to that. And again, we as human beings want to be right, especially with trading. We want to be as close to 100% as we can. That's just unrealistic. And so in many cases, you'll see a trader try to call a top or try to call a bottom. That's not what this is about. This is about looking for prices that have elicited a reaction so that we could then look and say, well, if that reaction continues, then great. I can look for 2 times my risk outlay or 3 times my risk outlay. If it doesn't, I can get out of there quick and prioritize risk management and loss mitigation for those episodes when I'm invariably going to be wrong. So let's get to the chart and start chopping this up. I'm going to go with an example in Eurodollar. I think it's just the simplest way to look at this. But in reality, psychological levels are something that play out in several other markets. I'm going to also show you an example in gold. I'm going to show you a quick example in S&P 500. S&P 500 right now is holding resistance at a major psychological level. They're worthwhile to look at and learn about. In Eurodollar, I'm pointing out this high. This is the all-time high in Eurodollar. Notice it comes in right at 160 flat. What's magical about 160? Nothing. It's just a rounded level. Above 160, it feels expensive. Below 160, it feels cheap. Now, that doesn't mean that it's going to remain that way. Like, we can gain acceptance above 160 in the same way that this pair had gained acceptance above, say, like 150 on that initial run, or 140 or 130. But you'll look, as we got up to 150, close to 150 for that first run, all of a sudden it feels expensive. Buyers stop buying, sellers start to try to take a shot. Now, it didn't work because we inevitably just got above 150. But at that point, the trend was so strong that there was motivation for buyers to push up until finally they got stymied at that 160 handle. But you'll notice once we do finally get resistance off of 160, look at what happens. This thing drops like a rock until we get down to 125. 125 is a level where buyers come in, staged a battleground for 4 of 5 months until eventually they were able to lift price and get back above that 150 test. But again, this is where it matters most. Seeing the reaction, seeing that we got the 160 test, and buyers felt that that was so expensive that they started to pull back from the trend. We even got a second test here, same thing. But in that second instance, this is where sellers start to take over. That's what elicits a reversal. You'll see it down here on the other side. We get down to 125, perceived value. It seems cheap. It's like if milk's normally $5 a gallon. Now you see it at 4.95, 4.99. Perceived value. Buyers jump on that. They jump on it again a month later, all the way until we get this reaction. We get this rally that tests above the 145 level. 145, which is prior support, now alternative resistance. We get back down for another retest of 125. Again, same thing, 2 consecutive months. So notice where that low holds in right there. The whole point of this is if you're seeing this on a daily chart, if you're seeing this on a weekly chart, you have the idea that that's the level with which it might bounce. Maybe it doesn't, but if it doesn't, you cut bait and you try to get out quickly. But if it does, then the result could be pretty attractive. You could look for a bounce of 3 or 4 times what that risk outlay inevitably was. And again, we can look at a number of these levels to see where other reactions had taken place. 120, a good example here on the monthly. As we get below 120, we even tested below 120 for a while. But that candlestick is very indecisive. That's a spinning top. If the body was a little thinner, you could call it a doji, but it's not. It's a spinning top. But what happens here is sellers go for that move, they go for the breakdown, and then buyers jump in on that test below 120 and inevitably push price back up, showing that indecision. Leads to a rally. That rally runs all the way until we get very close to that 150 level. But it's a good example of buyers failing to push up for that next test. But we can literally mark each 500 pip increment here. So like 155. Notice where it caught a couple of months of support right in here. Same thing, perceived value. We're looking at a monthly. You got to think of this on a shorter term basis, weekly, daily. Get below 155 after it's just a 160. It feels cheap. It feels like a perceived value. Buyers jump in, support price, push price right back up to that prior high. Lo and behold, we get the bounce. Well, 145 right here. And again, I could literally just dress this chart in these 500 pip increments. And you'll notice we get a number of reactions. Look at how beautiful that reaction at 140 is. Again, same kind of thing. This is simple stuff. It doesn't require, a PhD in mathematics. It's just very garden variety, simple human behavior that has a tendency to play out in varying ways. Our goal, our role as the trader, it's not to try to predict this stuff. It's to notice the reaction and just to try to look for ways to institute asymmetry. Now, again, these are just 500 pip increments. This is not every psychological level. I could go down to 100 pip increments. But look at the number of these swings and these inflections. They get caught right at these even rounded whole numbers. Major decision points. Now, it doesn't always start that way, but again, the point isn't to try to call every top and bottom. The point instead is to simply look for ways where I could try to risk $1 in effort of making 2. And this very simple study on human behavior can help us to do that. Again, we're going to take it down. And I'm going to get these levels as well. Now, this is the zone, the area that I've been harping on in webinars for a while, 115 to 105. Notice here for this like 2.5-year range, it comes in, shows resistance multiple times. Now, why is that taking place? Why is that happening? Well, let's think of who's actually in the Eurodollar market. Of course, as speculators or retail traders, we want to think of the little guy that's in there. But, the reality is if we think of who's trading FX, who's pushing FX markets, it's probably not the retail trader. It's global central banks, it's large multinational corporations, it's the Toyotas of the world that have to make payroll in Europe and the US. And when you have the Eurodollar at a 105 spot, that trader at Toyota, that the person managing Toyota's treasury, they're not going to get on a chart and do Fibonacci analysis and try to lever the trade. They're simply trying to even the flow from these currency fluctuations. They see price below 105. Hey, it feels kind of cheap. Not a bad time to sell some dollars and buy some euro. A couple months later, we're up at 115. Hey, euro's feeling kind of expensive. What a terrible time to take some of my euro reserves, diversify them into USD because I know I have to meet payroll in Pennsylvania in 2 months. So I might as well make that change now. Lo and behold, 115 holds, 105 holds. We get that nice little range. Now, it doesn't explain every movement because you do get trends, you do get motivation, you do get reason for buyers to pose breakouts, for sellers to pose breakdowns. That's precisely what ends up happening here. But notice we go right from 115 as resistance up to 120 and then up to 125. And then we're on the way down. 120 is support, or excuse me, 115 is support. Then 110 is support. And again, it doesn't catch every swing, but it gets a lot of them. And this is just very simple garden variety round levels. And that's euro dollar. As a matter of fact, if you look right now, look at what's in play. It's that 120 handle in euro dollar. And this is something I've been using in intraday and intraweek analysis for a while now. Look at this weekly chart. Look at how beautifully this has played out. 115 caught resistance back here in April. Comes back into support, support, support. I mean, I get this down to a daily or even a 4-hour chart. Look at how cleanly that 115 handle played on the 4-hour back in November. Two different doses. We get this higher low, and then you can see this on this 4-hour where buyers are coming in to defend 115 as a perceived value. When you get that bounce, especially as you get that short-term higher high, you have the idea that 115, it might hold. And there's an area where you could try to risk $1 in an effort of making 2 or maybe 3 or 4. It's the prospect of asymmetry and support and resistance bring that to the table. That's what brings this all to life. That's what gives us a way, again, to take a certain approach of looking for asymmetry in an otherwise uncertain world. This is just simple psychological levels. Now, again, this is euro dollar. And as you can see here on the daily, we had that test above 120, and it's pulled back. And lo and behold, it's pulled back, and it's held support right at prior resistance, which is something we'll go over in a future video. But that's just euro dollar. We could take this study, we could look at this elsewhere, right? And I think dollar yen as a really great example right now of how these psychological levels matter on a basis outside of just retail trading or retail speculation. In dollar yen, we've had the very real prospect of intervention. Like if we go back to 2022, when the pair is on a beeline higher, it had bottom sub 103 in early 2021, 2022. We're getting above 150. 150 was that line in the sand where the Ministry of Finance was like, hey, we need to calm this down. Let's intervene. Ultimately, the high was 150.195, but it was 150 that got their attention. A year later, or a couple years later, it was 160, right? Again, we touched 160 briefly, and then we got an intervention. We got an intervention, and price slashes all the way down to support at prior resistance, right at 150.195. We get back above 160, and again, Ministry of Finance says no, orders an intervention. It gets slammed. Now, when dollar yen gets slammed, where do you think it goes? Right down for a clean retest of the 140 handle. 140, a little bit above it in December 23, but a perfect hold of the low in 2024, perfect hold of the low in 2025. That's your support. These are just 1,000 pip increments. I mean, we could take this in a more detailed fashion. We could look at like 145 in dollar yen, 155. If you want to look at like intraday trading strategy, we could get even more granular with this. And we could go for something like a 159, a 158, a 157. Again, it's not going to catch everyone. The whole point isn't to try to predict or to try to be perfect. It's to look for areas where there have been inflections, where there have been reactions, so that we can then enter a very simple if-then statement. If resistance holds, then I can look for 2, 3, maybe 4 times whatever my risk outlay was. If it doesn't, then I can get out quick. That's dollar yen. Again, very simple. Round psychological levels. I consider the 500 pip increments as majors, the 100 pip increments as minors. I think the more attractive part is when you get a collection at one of these levels. You could see over like a multiple week, maybe multiple month period where buyers or sellers are responding to a certain or a particular price. And don't expect it to be perfect. But when you get something like what was happening here at 145, pretty good example of where buyers are trying to budge through. We get these higher lows, and eventually we get above, and then you got acceptance. Now that's in the FX world. Let's look at something else. Let's look at something else related. Gold. Same kind of deal, right? If you look at the swing high that came into play April of 2025 in gold, where do you think it printed? Right at 3,500 flat. Again, major round psychological level. It's not going to catch every single high or low. Like 5,000 as a good example. This paused the move on the way up, and then we just jammed right through it. But if you look at the highs that were in play before this whole theme started, it's right at the 2K level. Psychological levels, human behavior, they have, after all, the chart is a manifestation of how humans have pushed prices. If we as human beings are governed by this simplicity with psychological levels, it makes sense that they're going to show up on our charts as usable aspects of trading strategy. Get a little shorter term with gold, and you'll see that, again, a lot of these inflection points, like the high that came in earlier today. Recording this just after gold set a fresh ATH. Look where that's at, right at 5,600. Go down and say something at like 5,100. Oh, that's what caught the low after the high of 5,600 came into play. There was also resistance on the way up. So resistance turns support. Also a beautiful inflection. If you're watching this short term, you see that on like a 30-minute chart. I'd even tweeted this level out whenever it was in play. Holds the low, holds the bounce, leads to a pretty strong, vigorous move all the way back up to a 5,400 retest. These levels could play out in a lot of different ways. And again, this is gold. We looked at a couple of currency markets. Let's look at SPX. That's stocks. That was a little messy. Let's go for something a bit more clean. Oh, this one just happens to have all those psychological levels already identified. Again, don't expect it to be perfect, but you'll get a lot of these instances where it shows very cleanly. And right now, the big level that's in play is 7K. We traded above it briefly on Fed Day, and then we dropped in a pretty dramatic fashion. But notice buyers so far picked it back up. So it looks like they're vying for another retest of that 7K level. But you go down a little shorter term, look at 6K. Initially holds resistance. There's still a lot of momentum behind that trend back in November of 2024. That was just after the U.S. election. And so there was a lot of reason for buyers to try to jam this higher, which inevitably they did. But then we got the pullback. Look what's happens around 5K. It doesn't perfectly catch the low, but a perceived value. We get below 5K. It seems a lot cheaper than when it was at 5,001. Buyer behavior, it shifts, it changes, it takes over. We get this bounce, we get this higher low, then a higher high, and then bulls are running off with it. Then we get back up for resistance to that 6K level. You can look at this in a lot of different ways. The first test of 5K, again, wasn't clean. Rally, pullback, support, prior resistance. You look at 4K. The first test above 4K, right? The first test above 3K. Resistance, support, that it'll show in a lot of different ways. And again, these are just the major levels in SPX. If we go to current date, we could go for something like 6,900, 6,800, 6,700, 6,500. There's a lot to work with here. But again, the whole premise is to find where there's been a reaction, an effort of instituting an if-then statement. If this support holds, if this bullish trend continues, then I could be in a good spot. If not, then get out. I'm wrong. I don't want to stick around to see how wrong I might have been and just hope that I can end up being right, because that's not reality. The reality is those are the situations that really end up draining us, because we let a short-term trade become a long-term problem. And at the end of the day, all that we have as traders is our own psychology. And that's the kind of thing that you're really going to beat yourself up over. But that's, my friends, is what I have for this week's educational video. And next, in future educational videos, we'll go down other fields of support and resistance, other ways of identifying workable, tradable levels, and how we can institute them into our approach. But thank you for your time. And as always, happy trading, ladies and gentlemen.